Okay, since rates are still in the sevens, what's starting to trend from the mortgage industry is 2-1 buy down scenarios. I want to tell you why I don't think this is the ideal way to spend money. I'm Andrew Gavin. I'm a California mortgage lender and I sell real estate here in San Diego. Now, these 2-1 buy downs are marketed as a way to temporarily lower your mortgage rate. And that absolutely is correct on paper. If you get a mortgage with a 2-1 buy down, the first year, the second year, your required payment will be lower than the payment that you qualified for to create the loan. However, you're not saving a single dollar. And this is the exact reason why I'm in no way a fan of this product. Now, there's lots of different ways you can manage your loan, close your home purchase, use cash of your own, any type of a lender credit, a seller credit, potentially a realtor credit. There's all kinds of options. And a lot of times when rates are high, like they are right now in the sevens, most buyers want a lower rate, which in turn creates a lower mortgage payment. They can't necessarily change the price of the house they're buying, but if they can manipulate the rate, that can lower the payment for a period of time or potentially for the term of the loan. The catch to this whole scenario, this 2-1 buy down, where in year one, your payment is based off of a lower interest rate. In year two, your payment is still at a reduced rate, but a little bit higher. And year three through 360, you end up using the rate that you qualified at. That sounds great when you're talking about it, when you're saving $300, $400, $500 that first year compared to the payment that you qualified for. However, you're not saving a single dollar. What you're doing is you're paying a lump sum up front to cover the interest for the first year and the second year, and it's a significant amount of money. I put together a scenario, and I'm going to go through it with you and show you what this means. But my reason behind not supporting this and thinking it's the craziest thing ever, it's that there's no actual benefit except you're writing a smaller number on your mortgage payment, and there's not a single dollar saved of interest. You're prepaying interest. The example I like to use is if your cell phone bill is $200 a month, would you pay $1,200 or $2,400 in advance? So for the next 1 or 2 years, your cell phone bill would only be $100, even though you can afford the $200, which you qualified for? Most people wouldn't do that. Would you prepay for 12 months of gasoline if you didn't save a single dollar? Let's say you put $200 a month into gas. Would you pay $1,200 up front? So instead of paying that $200 a month, you only paid $100? Most people wouldn't, because there's no reason to. You're not saving a single dollar. So pay over time, which is the reason that we have a mortgage or a car payment or anything else like that. We have loans because it makes more sense to pay in small chunks because we can't afford, or it doesn't make sense to pay for a large item up front. Now, a mortgage and a car payment, as I used as an example, you pay extra interest to be able to make that smaller monthly payment. In this scenario, you're not saving anything. You're just prepaying that interest. So I'm going to show you this scenario that I put together. It's a $500,000 purchase. The buyer's going to put down 20%, $100,000. They're going to get a loan for $400,000. Currently, rates are right about the sevens. A 7% interest rate for 400,000 is about 3,300 bucks. Now, the 2-1 buy down allows you to make a temporary 12-month payment based on 5% interest rate for that $400,000 loan. That's a $2,800 a month payment. It's about $500 lower than the payment you qualified for, saving you about $6,000 a year. Now, year 2, you're going to pay 6%. That's about $3,000 payment. You're going to save about $250 or $3,000 for the year. Now, in this scenario, we've got closing costs of about $15,000. That's all loan fees. Your down payment, $100,000, 20% of the purchase. So your total cash to close that you need to pay the mortgage company and wire to escrow is going to be $115,000. That's meant to come from you. Now, let's say in your deal you negotiated a 2% seller credit. They're giving you 10 grand. And your mortgage guy is saying, let's do a temporary buy down. So instead of paying $3,300, your payment's only going to be $2,800 for 12 months. For 12 months, that's it. But year 2, your payment's going to be about $3,050 for the next 12 months. Then starting of year 3 all the way to the end of the term, 360 payments, your payment goes back up to $3,300, which is the mortgage payment you qualified at. That sounds great. I'd rather pay $2,800 than $3,300. I'd rather pay $3,000 than $3,300. But the only reason that you're able to do that is because at 5%, you're going to save $6,000 of interest. At 6%, you're going to save $3,000 of interest, $9,000 total for the 2 years. So a 2-1 buy down is going to cost you $9,000. Luckily, our seller agreed to credit you $10,000 for whatever closing costs you need. Now that might be based on some repairs you need to do for the house. Maybe there's termite damage that needs to be worked on, an old furnace, who knows? But for some reason, they gave you $10,000. And your mortgage guy is saying, let's do this 2-1 buy down. It's a great idea. And the seller will pay for it. Well, the seller's not really paying for it either. The seller's giving you what they agreed to, 2% for closing costs. They have no control over how you spend it, but the mortgage guy that talked you into this 2-1 buy down is saying spend it on this loan so we can get you that super low $2,800 payment, which probably beat out some other lenders because they were quoting you $3,300, which is the typical rate. So here's the thing. You could certainly take the $9,000 from the seller and pay that and have the $2,800 payment for the first year and $3,000 for the second year, and then it bumps up to $33,000. But you already have to go into your bank account and pull out $100 grand for the down payment on the loan and another $15,000 of one-time fees that you have to pay. So in this scenario, for me, you have $10,000 of seller credit. To get this purchase, you qualify for a $400,000 mortgage at 7% that's going to have a mortgage payment of $3,300. You went into this purchase thinking you could potentially have a $3,300 mortgage payment. And if that's okay with you, I would suggest that you use that $10,000 of seller credit and pay it towards your closing costs. It can't go towards the down payment. That has to come from you. But it can go towards those closing costs. So in essence, you're going to pay your $100,000 down payment, which is still your money, just tied up in the mortgage, but it's your equity. So day one, you would have $100,000 of equity because of the way that you purchased this home. But you also have $15,000 of closing costs. So in my opinion, it makes a lot more sense to take the whole 10 grand and pay it towards the closing costs. So instead of coming out of pocket $115,000, you're coming out of pocket $105,000. You're keeping your 10 grand in your own bank account, and you're using the 10 grand that the seller gave you. Now, you're managing your own 10 grand. And I don't know what kind of job you have, but for most Americans, getting a lump sum like 10 grand at one time isn't that common. Unless you're in a very high commission sales type job, you probably don't see commissions in $10,000 to $15,000 that come in all at once. Whatever job you have, you're already probably used to living within your means within that income. Getting an extra 10 grand for anybody is going to be a benefit. So if you have this $115,000, which we know you do because we've gone through your mortgage with you, instead of paying that 115, you're going to keep 10 grand of your own money in your own bank account, which you can pay towards your mortgage if you want over the next 2 years, and essentially work this 2-1 buy down scenario yourself. So instead of paying $115,000, you're going to pay $105,000, and you're going to use the seller's money. Now, you have 10 grand left. You could pay it towards your mortgage, but if you did add it to your mortgage, it would go towards your principal, meaning that it's still yours. And you could just pay the $3,300, which you qualified for, which fit into your budget based on the mortgage math that allows you to qualify and get approved for this loan. And over the next 12 to 24 months, you're going to write a larger mortgage payment. But when you've lived there 6 months, you've now paid $3,000 worth of interest instead of prepaying $9,000 in interest. In 12 months, you paid $6,000 of interest, but at least you've lived there. And that's why this doesn't make any sense to me, because once the seller has given you that credit, it's your money to use. Now it's tied up in escrow in the deal, so you want to use it all for the deal. But use it to pay fees. Don't pay something like mortgage interest. Don't prepay mortgage interest because it sounds good. It's really not. It's still $3,300. You've just prepaid some of the interest, and they're holding it. The mortgage servicer is actually keeping the $9,000 in an escrow account that will specifically go towards the 2-1 buy down for the next 24 months. So all you've done is hand over this money to someone else to manage. What I'm saying is this is a horrible idea. Why would you ever give $10,000 to someone else to manage when there's no benefit to you at all? You're not saving a single dollar. So for me, I absolutely hate this thing. You could take that same 10 grand and instead of doing a temporary buy down and prepaying interest, you could actually pay 10 grand towards buying down the rate permanently, getting a lower rate, which would help you on the first month all the way through to the 360th month if you paid off this mortgage. But in that scenario, you're going to save a lot more money over the longer term of the loan, where this $9,000 for the 2-1 buy down, the only thing that it does is allow you to write a smaller number on your mortgage payment for year 1 and year 2. It doesn't save you a single dollar. All the marketing behind this is great. It's very enticing because everybody purchasing a house based on today's rates and prices wants the lowest mortgage payment possible. They want to pay the lowest amount of interest. A 2-1 buy down is not the way to do it, in my opinion. There are other ways to save money on your mortgage, on buying a house, on your fees. If you want to find out some more options, please reach out to me. I would love to help you. If you have more questions about a 2-1 buy down, I'd be happy to help you walk through that as well. In my opinion, this is not a good program for most people because it does not save you a single dollar.